Mortgage applications plunge as rates hit their high of the year. I'm here with Shanthi Bharatwaj, reporter for The Street. Shanthi, tell us, many worry that this may set back the housing market's recovery. So is that a likely scenario?
Well, mortgage applications are declining quite rapidly. They plunged 13.5% last week. But this is still mostly refinance activity that's declining. Refinance activity is a lot more interest rate sensitive. Higher rates means borrowers have less incentive to refinance. But purchase applications are also slowing down. They declined about 3% last week, and that shows that buyers are slowing down. But it's a little too early to tell, because buyers are slowing down, one, because interest rates are rising, but also because inventory is low. There's not enough homes on sale. So if we see inventory rise, perhaps buyers will start returning back to the market. And interest rates is not the only thing that sort of determines the housing recovery. If the economy continues to add more jobs despite the interest rate rise, then we could still see housing tracking quite well.
What about the effect on the banks? We saw Bank of America just announce thousands of layoffs due to weak refinancing. Wells Fargo expects to make 30% fewer home loans this quarter due to rising rates. So how widespread do you anticipate the damage to be?
Well, for banks with big mortgage business operations, that division definitely takes a hit. In fact, JP Morgan said that it expects to make a loss in the second half for that business. The problem is refinance has sort of propped up the activity of the big mortgage businesses for a long time now, for the last few years, as rates have been low. And with that going away, purchase applications isn't going to make up that share. And even with expenses, they're all slashing jobs and expenses to sort of boost profitability, but that takes a while to adjust as well. But big picture is for the big banks especially, rising rates long term actually improves the profitability of their lending business, which is a much broader and bigger business and really their mainstay. So net they'll actually be positive in the long run. But yeah, the immediate impact is going to be a little lackluster.
All right, so how do you anticipate all of this now playing into the Fed's considerations about tapering when they meet next week?
Well, the Fed clearly looks at a very broad range of data and not just housing. They have said that they will monitor housing really closely. But the problem for the Fed is so far the data isn't showing them a conclusive decision one way or the other. The jobs data was not great but not terrible, and so the idea is that perhaps the Fed might decide to taper after all, but they might decide to just do a very light taper and not a big one. So we still can't say, and the jury is out on that. And perhaps later this month we get existing home sales data in September, which will again reflect the impact of rising rates. But I think the Fed's decision will actually consider a much broader range, not just housing.
All right. Well, thank you so much, Shanthi, for breaking that down for us. I'm Brittany Umar for The Street.